Good afternoon, everyone. Thank you for joining for our Q2 Manufacturing Outlook webinar today. I'm Richard Austin, BDO's Head of Manufacturing. It's been an interesting half year, I think, for everyone in manufacturing, especially in the UK. Manufacturers have been dealing with a number of challenges, including obviously geopolitical events. There have been new COVID-19 restrictions in China, clearly a tight labour market, and as we're all starting to see now, significant increases in inflation as well across the board, all of which are slowing sectoral growth and are particularly relevant for the manufacturing sector. So I think this quarter is going to be very interesting in terms of the update. We're very delighted to be joined by Make UK's Chief Economist, Seamus Nevin, who'll be providing a more in-depth view and update on the state of UK manufacturing and sharing findings from our latest Make UK and BDO Manufacturing Outlook report, which came out this week. We're also going to be joined by BDO's corporate finance experts, Roger Buckley and Dougal Baxter, and they'll be sharing insights into the key M&A trends and themes in the manufacturing sector, the key considerations for M&A activity in the current environment, as well as some practical tips to show you that you should consider to help position your business for sale. So also very interesting, and that comes off the back of one of our M&A reports that we recently put out. So following that, we'll have a live Q&A session. So please do submit any questions you have through the Q&A functionality at the bottom of the screen, and we will pick those up at the end. So without further ado, I will hand over to Seamus at Make UK. Seamus.
Good afternoon, all. So I'm going to quickly run you through the overview to start you off, just giving you some headline figures for this quarter's survey results, and then we will go into more detail as we progress. So on the first slide, you will see that output and orders are still positive this quarter, but are exhibiting continued decline, and new order growth is becoming quite pedestrian. UK and export orders have both slowed, and price growth is again record-breaking, but margins are falling sharply. Employment is also slowing, and investment intentions have taken a nosedive, and the expectations amongst firms this quarter are to maintain growth regardless of these conditions, although I will go into some details around the qualifiers for that shortly. But based on these results, we have revised down our manufacturing output growth forecast for both 2022 and 2023 marginally. So for 2022, we're now expecting growth of 2.3%, and for next year, we're expecting growth of 1.7%. And for UK GDP overall, the forecast has also been revised down for both years. This year, we're now expecting a slightly lower 3.6% growth for the overall economy, and next year, 1.4%. So I'll take you onto the next slide. The lockdown lags mean that total order balance for the latest quarter research indicates a much sharper slowdown in growth of new work. The latest balance of 20% is less than half the level from last quarter, which was 42%, suggesting that the demand boom that we have seen since the end of the lockdown may finally be coming to an end. The gap between the balance for output and orders, which is the difference between the red and the orange bars on your screen, has also shortened in absolute terms, which may be a sign that the supply chain challenges are easing. However, total orders remain twice the size of output levels, indicating substantial delivery challenges persist. Indeed, Make UK members have consistently highlighted the difficulties they face in accessing components and raw materials, which is making it more difficult to deliver on customer orders. On the next slide, you'll see that export orders are falling and UK orders are still strong. So UK orders continue to outperform export orders, relatively speaking, reporting a balance of 16% for this quarter. However, the rate of growth for the domestic market has approximately halved between the first and second quarters of this year, suggesting a significant impact of recent events, including supply chain issues that have and the effects that they're having on UK markets. That said, a positive balance of 16% still indicates growth at a level that far outweighs the growth seen in the export market, which is 4% on balance. This marks the 7th quarter in a row the domestic market has technically expanded in terms of orders, despite the obvious slowdown in the rate of growth. However, as industry continues to slow and business faces increasing costs and the risks of a decline in the domestic market also grow. The sharp slowdown in new export orders is not surprising, given most recent shocks to the supply chain have been both external and international in origin. The two main changes between this quarter being the Russia-Ukraine conflict and the resurgence of COVID-19 lockdowns in China. In addition, the UK continues to face unique export challenges brought on by the change to our trading relationship with the EU, which is our biggest market. And from the perspective of EU manufacturing, this change has made the UK less attractive, a less attractive market to buy from, which is affecting businesses here. The concern for manufacturers now is how the tensions around the Northern Ireland Protocol might increase those difficulties for members if we are to be subjected in this country to EU trade sanctions, or perhaps even sanctions from the US, which supports the continuation of the Northern Ireland Protocol in its full form and full implementation. Moving on. The COVID upsurge in China has seen inquiries from Asia increase. So recent events from the COVID-19 pandemic to the war in Ukraine have severely disrupted global trade patterns. And the UK faces all the same challenges as everyone else around the globe in this regard. But our underperformance in export sales compared to other economies is explained, according to recent reports by the International Monetary Fund and the World Bank, by Brexit, which is holding back our export growth recovery. More recently, the World Bank has also raised concerns about lockdowns in some of China's major trade cities, including the financial, manufacturing and shipping hub of Shanghai, which is the key global trade port, not just for UK firms, but in many cases for firms in countries with which the UK also trades. So it can have knock-on effects across the board. And the World Bank predicts that these could add further to slowdowns in trade across the globe. But the interesting thing to note is that this quarter, at least in the short term, factory shutdowns in China have led to a slight increase in interest from companies in the Far East seeking new sources of goods elsewhere, and that has seen an uptick in demand for UK-made products from those markets. Our other key markets, the EU, which is always and has been for a long time our biggest, and North America remain relatively unchanged compared to the usual performance we see in most quarters. Moving on to the next slide. The rising cost of doing business is starting to hit manufacturers harder than ever before. Not for the first time in the last few years, firms are having to make difficult choices as to whether to continue operations or shut down processes temporarily to save on energy and other costs. Insolvency firms are seeing a growing number of UK businesses at risk of going under as costs spiral and COVID-19 loan repayments come due. Fortunately, demand remains high, but access to inputs has made delivering on those orders more challenging. And despite the downward trajectory of the last 3 quarters, manufacturers still expect faster growth in the future. This was also predicted in Q1 of our Manufacturing Outlook report, but did not come to pass in the last 3 months as the industry faced a plethora of unexpected extra challenges from the war in Ukraine to the COVID-19 lockdowns in China and other more bespoke difficulties as well. So given how quickly the economic environment has changed between Q1 and Q2, we have to take these results with a pinch of salt. It's a bit more challenging to accept businesses' own predictions of the next quarter as being entirely accurate. Uncertainty has impacted manufacturers since mid-2016, and it seems probable that there will be further unpredictable events to come in the coming months. So manufacturers will have to remain agile and responsive. On the next slide, you'll see that this is the 5th consecutive record-breaking quarter for prices. So from rising energy bills to logistics, increased wage demands, raw material costs, and the highest tax burden faced by business in over 70 years, the UK manufacturers have seen it all in the last few months. Our latest survey results show prices have continued to expand at record rates for almost 5 quarters in a row. UK price growth has shown some marginal slowdown, reporting a balance of 54%, down from 58% in our previous survey results, but it's still the 2nd highest balance in our survey's 30-year history. Export prices continue to speed ahead, reporting a balance of 52%, up from 50% last quarter. and the acceleration of rising export prices is likely also played a role in decline of export orders, which saw a more severe slowdown in growth than domestic orders this quarter. According to the Office for National Statistics, input inflation is at 18.6%, the highest in the survey's history, whilst output inflation is rising at a relatively slower but still colossally high 14%, the highest since the global financial crisis in 2008. Unsurprisingly, UK manufacturers are reporting continued declines in profit margins as the cost of doing business rises to unsustainable levels and raises the risk of higher insolvencies if businesses end up defaulting on their debts. It's important to note here as well, as Make UK predicted almost 2 years ago, the really challenging time for businesses was not necessarily the lockdowns itself, but rather the expansion phase as things start to open up again, and we're beginning to see the first effects of that now. The cost of doing business is increasing right at a time when customers are coming back and businesses are starting to open, but all of the difficulties or not all of the difficulties that members have faced have gone away just yet, because there are still knock-on effects from supply chain difficulties, etc., that will need to peter through the system, and that will pose a risk, particularly for those businesses that are the most cash-strapped at the moment. Anyway, moving on to the next slide, we'll see that optimism as a result of all of these conditions is softening as performance declines. So this quarter's manufacturing outlook report finds that firms' confidence in business conditions remains optimistic overall, despite ongoing challenges. However, confidence in the UK economy has turned more negative this quarter for certain parts of the UK, which is below the 5 inflection point that marks the mirror, or the middle line, middle horizontal line on your screens. Unsurprisingly, most areas of the UK have reported a continuation of the downward trend in optimism seen over the last few quarters. It's apparent that both ongoing and novel challenges are beginning to bite manufacturers' operations, and that is making it increasingly difficult to stay positive about the next 12 months. Still, confidence is a volatile metric and can change dramatically depending on the day-to-day performance of a business, as well as news surrounding the UK economy and wider political situation. So it doesn't necessarily always correlate with future performance. However, as was the case in the last few quarters, the declines seen in confidence are mirroring declines being reported for output on orders too. So this seems a little bit more accurate than usual. The biggest issues that have impacted confidence levels recently include the cost of living crisis and the escalating cost of doing business. Manufacturers are facing rising costs for raw materials, labor, energy, and freight transport, as well as significant tax burdens as well. Coupled with these, the cost is growing in terms of businesses accessing raw materials, labor, and freight transport, even when they are willing to pay a higher price. So it's not necessarily the case that the market can respond in the way that some economists might automatically predict based on the textbook understanding of these situations. The reality is that even when businesses are willing to pay a higher price, they're not necessarily always able to get the goods or the labor or the services that they need to keep going. In line with the national average, all regions and devolved nations across the UK have reported a decline in confidence this quarter. So it seems fairly consistent throughout the economy, and unfortunately there aren't any exceptions in that regard. On the next slide, we'll talk about employment and investment. So Chancellor Rishi Sunak has recently warned that the economy faces a perfect storm. At 9%, UK inflation has not been this high since the Consumer Price Index was invented in 1982. And the older retail price index measure is even higher at 11%. The usual remedy is to raise interest rates, which makes it more expensive for consumers and businesses to borrow, meaning they spend less, helping to cool demand and in turn slow the pace of inflation. However, about 4/5 of the current rise in inflation is driven by global energy and food prices, meaning domestic interest rate hikes, which we saw again last week, will likely have little relative effect. The Bank of England's governor, Andrew Bailey, has warned that the UK could therefore be on the brink of a recession, which is defined in economic terms as the economy getting smaller for 2 consecutive quarters. Insolvency firms, as I mentioned earlier, are seeing an uptick in the number of firms being classed as at risk of going out of business because of spiraling costs and COVID loan repayments coming due. The Office for National Statistics revealed last month that the UK's economy shrank by 0.1% in March and fell again by 0.3% in April after the national insurance hike and myriad other increases in costs, including on energy, VAT, council tax and broadband bills all kicked in around the same time. The services sector, which makes up the largest share of the UK economy, was the main contributor to the contraction, but the worst performing subsector was in manufacturing, with the motor industry struggling as sales fell and supply chain problems hampered production. So despite 5 Bank of England interest rates increases since December and money markets expecting more in each of the Monetary Policy Committee's next 4 decisions, the pound is, relative to the other major economies, one of the worst performing currencies this year. And that's at a time when other currencies are also performing poorly anyway. The euro sank to a 5-year low against the dollar, raising expectations that the world's 2 most traded currencies could soon reach parity for the first time since 2002. Parity is an indicator of a lack of faith in the euro area economy, which, despite trade falls since Brexit, remains the UK's largest export market for British-made goods. The head of the World Bank has warned that Russia's invasion of Ukraine is causing a global recession risk as food prices, energy prices, and fertilizer costs experience the largest commodity price shock since the oil crisis of 1973. Around 3/4 of the rise in inflation, the rate at which prices rise, comes from higher electricity and gas bills, according to the Office for National Statistics, and energy prices are set to increase by more than 50% this year, pushing up bills for both households and businesses. The cost of filling an engine has also risen sharply for businesses and consumers, including freight transport companies as well. The average cost of a litre of petrol has increased by 25% since September, for diesel by 30%, according to the RAC, and even electric vehicles, which are usually half the cost per mile compared to filling a family car with petrol or diesel, has risen. The cost of driving an electric vehicle has risen by 21% this year. So right across the board, costs are going up. The oil prices are expected to remain elevated well into 2024, so there doesn't seem to be any immediate respite in store, as the barrel of benchmark crude, Brent crude, is projected to average over $100 this year. For manufacturers, higher prices in the UK risk becoming embedded due to these input cost increases, including the knock-on effect that they will have on wage demands as the cost of living spirals as well. In addition, the war in Ukraine, it is said, will severely set back the global economy. Economic recovery, with the UK hit harder than most, the International Monetary Fund has said. The UK is now expected to be the slowest growing G7 economy next year and the second slowest in the G20, lagging only behind Russia, which of course is also subject to significant sanctions as a result of its invasion of Ukraine. So it's perhaps inevitable that manufacturers say that their employment and investment intentions have taken a hit. On a positive note, the ONS stats do indicate that there are more job vacancies than unemployed people in the UK for the first time since records began. The unemployment rate fell to 3.7% between January and March, which is the lowest for almost 50 years, as job openings rose to a new record high of 1.3 million vacancies. The data shows there has been a rise in the number of people moving from economic inactivity, which is classed in technical terms as though those aged between 16 and 64 who haven't been in work or seeking a job. So there's been an increase in that category moving into employment. At the same time, people moving from job to job has also reached a record high owing to career changes post-pandemic. However, total employment remains below its pre-pandemic level because around 500,000 people have left the UK labour market over the last 2 years owing to post-Brexit immigration barriers, older workers retiring at a higher rate during the lockdowns, and more recently a rise in long-term illness, notably long COVID. Considering the anticipated hit from the pandemic, these are surprisingly positive figures, but they don't yet reflect, or they aren't yet reflected in real earnings, as figures show the impact of the pandemic and the economic squeeze is beginning to bite. So wages, excluding bonuses, have failed to keep pace with prices as inflation eats away at living standards. The 5-decade-old market research firm GfK's survey found customer confidence to have fallen to one of its lowest levels since 1974 when they began their survey. Indeed, such is the extent of the hit on consumer spending power that the Bank of England sees the economy heading towards recession and unemployment starting to rise before the end of the year. In sum, inflation, higher energy prices, labour shortages, and the war in Ukraine have made firms pause investment, stopping them creating new jobs and paying higher wages, or so we expect over the next few months. And the World Bank has also raised concerns about lockdowns in China in particular, having a knock-on effect that will slow down the wider world economy, which will in itself also impact us here in the UK. So little respite, unfortunately, appears to be in sight, at least in the medium term. Based on all of that, as you will see on the next slide, we have revised down our growth forecasts for both this year and next year. So manufacturing output growth forecast has been revised down for 2022 from what it was previously, 3.1%, to now 2.3% today. But in 2023, our forecast remains relatively static at 1.7%. For the overall economy, UK GDP growth has now been revised down for this year from our previous expectation of 3.8% to now 3.6% growth for the year. And for next year, 2023, we expect growth to have declined from our previous forecast of 1.6% to now 1.4% for the year. So just to review, before I pass you on to the next speaker, output and orders are still positive, but have exhibited a continued decline, and new order growth is slowing. And it's both UK and export orders that are being affected. Price growth and the costs of doing business are increasing at a record-breaking rate, and as a result, profit margins are falling sharply. The result of all of that cumulative effect is that both employment and investment intentions have taken a nosedive, albeit firms remain relatively optimistic that they will continue to grow this year. Nevertheless, we have revised down our forecasts both for the manufacturing sector itself specifically and for the UK economy as a whole, both for this year and next year, albeit those revisions are only marginal, so I wouldn't be too pessimistic just yet. That's all from me, and I can pass you on to the next speaker now. Thank you for listening.
Thank you, Seamus. It's one of those things where you follow a speaker after that level of intensity and concern, and then start talking about navigating M&A amongst all of that maelstrom, I think is probably the word to be used. And the purpose of today really is to try and cut through some of the noise that you might experience when listening to what's happening in the M&A market. But share with you the facts as to where we are, explain to you some of the drivers that are helping to drive the M&A market, and the reasons why people are still engaged in M&A, despite the backdrop that's just been explained. And perhaps share with you also a few ideas around tidbits, helpful hints, some of the key themes and drivers for creating value, which may be relevant even if it's not something that M&A is currently on the agenda, but maybe in the future. So if we move on, the key agenda, M&A trends, consideration, practical tips, and then an outlook, which is a dangerous thing to do in this environment, but an outlook for predictions for the next year or two. So to the facts. This slide shows you the number of transactions which have happened in the UK over the last 3 years. So the left-hand column talks about 2019, 2020 middle column, 2021 last year is the right-hand side. The context of this is that just under 800 transactions happened last year in the manufacturing sector. Clearly a significant increase on 2020, COVID years as you would expect, but also an uplift on 2019 pre-COVID. So an element of catch-up was evident. You'll see that the red column on the left-hand side, the red box, each of these are quarters, so quarter 1, 2, 3, and 4 in the different colours. Q1 was affected in part by a level of anxiety around capital gains tax increases for people who were owner managers, and an element, as I say, of catch-up from the 2020 year as people were looking to reposition their businesses based upon what they had learned through the COVID piece. Moving on, what we saw was that the increase in M&A activity was across subsectors. The left-hand column, which is the largest subsector, is called engineering services. It's a bit of a catch-all. But going across, you look at food and drink, building products, life sciences, materials, industrial automation, etc., etc. And what you'll see is that for the vast majority, there's an increase in activity, which varied across subsector. But nevertheless, what it shows is that there is interest in either consolidation, expansion, product expansion, geographical expansion, whatever is the driver of the M&A across the piece. Next slide, please. What's an interesting factor is the level of trade and private equity transactions. Many people think that private equity actually account for a larger percentage of the M&A market than they do. They're very good at publicity. But roughly speaking, 1 in 5 transactions account for buyouts, private equity type transactions, but the majority still relate through to trade acquisitions. In terms of subsectors, it says there, private equity has been particularly interested in food and drink, and process automation in its various forms has been another key sector, which accounts for a large percentage of the private equity interest in the industrial space. Moving on. So, who is acquiring? The UK market has got 3 principal areas of interest. You'll see here that there is a chart which shows the various countries from which the acquirers have been sourced, with the United States and Canada being the largest provider of transactions for people who are acquiring. That's been consistent across the piece. And I, for one, as an M&A practitioner, very grateful that the BDO team in the US has a business which is nearly $2 billion, which we can source buyers from. North America continues to be an M&A market, at least, which values the UK market. Always has had an interest in the UK as the bridge into Europe. And perhaps surprisingly, that has continued post-Brexit, as the US and Canada still see this as a good place in which to deploy capital and as a launchpad for the European markets in some cases. Next slide, please. We track in the listed market how industrial businesses trend against the FTSE 100. This is a long-term view. Each of those data points is a year. So clearly, this is to the end of 2021. There's been a decline in both since that date. But what is shown is that the industrial sector has actually outperformed the FTSE 100, which is interesting, perhaps surprising. But multiples of profit upon which businesses are valued has been volatile in the short term, but shows a continued upward trend. And perhaps over the longer term would be continuing that trend, in our opinion. Next slide, please. So, those are the facts. So what are we actually seeing in terms of key market themes? For any acquirer, some of the things that we are hearing repeatedly, supply chain resilience won't be a surprise to anybody on this call. The sound of the ESG agenda, the volume of noise going through to that agenda and the level of interest in it undoubtedly has increased and continues to increase on a yearly basis, albeit from a low point. To an extent, that's evidenced by the fact that there is a new subsector of due diligence called carbon due diligence, which seeks to look at the carbon impact of manufacturing businesses, both now and in the future, to see whether or not the sustainability question has been asked and answered. whilst there has been clearly a huge amount of disruption, maelstrom, as Seamus said, nevertheless, for some businesses, strangely, perhaps perversely, the business models have proven to be very resilient, agile, and there is a level of restructuring of certain sectors where pricing has been increased to improve profitability margins. And I appreciate that that comment is made in the context of declining profit margins overall, but that's certainly not the case for all businesses. Automation and digitalization is a theme which we continue to hear, and certainly some of our capital goods manufacturing clients have got order books stretching out now to 2024 in some cases. That used to be based on a return on capital type calculation. These days it's now seen as being more business critical, just in terms of actually keeping operations going to the level and extent that's required, partly because of the staff shortages. Private equity continues to look and prowl around industrial businesses, if you like, with a view to finding and investing for the future. And they are good drivers, both of volume and particularly of value transactions for us. We've seen diversification being a key theme for corporates. That could be geographical, but it's predominantly product in terms of breadth and depth. And the calculation being in that case that actually it is easier to acquire than to build from scratch. Raw material shortages, input prices have been well versed. Inflation clearly is the new kid, effectively, 12 months is new. On the block for an M&A perspective, management teams have been dusting off their experiences of inflation in the past, or dusting off the textbooks in terms of how to deal with it. And we have clients who are already at the 8th price rise in terms of their own business and putting them through to the market, which is really testing the elasticity of demand. And whilst everyone talks about it, still shortages are actually a driver for M&A in some instances too. Next slide, please. So what I'd like to do is now pass you across to Dougal Baxter, one of our excellent transaction services partners, to talk about the due diligence aspects and some of the key changes there. Dougal.
Thanks. Yeah, so as Roger said, I'm a transaction services partner, and for the layman, that means I do DD for a living, due diligence, financial. I do buy side and sell side. I've been doing it for several years. And one of the key things that has changed over the last couple of years is the way that we do it has changed. So principally for the last 15, 20 years, DD has been very reliant on the management accounts that a target business produces. And obviously management accounts are a summarized version of a company's transactions. And sometimes the management accounts, even for large companies, small companies, they can be mixed in what they show. They might consolidate revenue. They might not show detailed margins, and they might be on an inconsistent basis over the review period. What's been happening in the market for the last 3 or 4 years is that DD now sometimes tries to look through the management accounts. So rather than specifically asking for management accounts on day one and producing a report based on those records, we ask for detailed transactions or the general ledger or the TBs. But sometimes we might get 20, 30 million lines of transactions and use those as a basis for our analysis, which is quite different to the previous way of doing it. That is very useful for both the M&A advisor, the DD provider, and obviously the acquirers, because it gives a lot more insight into business performance. We're finding it especially useful in the current market. Historically, management accounts might be out of date. You wouldn't pick up trends around price changes until the stock sort of starts working through the system. Now, by having more up-to-date data, granular data, we can see things much quicker, and we can make much more insightful comments for buyers as they're coming through the process. If you want to flick on to the next slide, hold it. Thank you. So as you can see there, so typically, historically, people have relied on audited accounts, management accounts, selected KPIs that management teams use on an ad hoc basis. What we do now is we source data from a whole host of different structured data sources and unstructured data sources. We're looking at every sale of every product. On occasions, we can see margins that companies are achieving through project ranges to customers. We look at their processes. We can analyze performance at a site level, at a process level, and look at revenues and margins and how trends have changed. We can see effectively on a sort of a monthly basis how inflation is affecting the performance of the business, whether that be employment costs, whether that be energy costs, whether that be supply chain logistic costs. We can look at run rates on a much more granular level than we used to. So diligence across the board, I think, is becoming more insightful for people. And an interesting thing is that can happen for both large transactions and small transactions. So sometimes you might come across a large corporate looking to buy a small OEM or owner managed business, which has a limited amount of financial information in their management accounts, but actually within the system you can break it down into much more detail. So quite often the diligence provider can provide more insightful information than actually the management team that run the businesses know, depending on how you extract the information. So for those who haven't done a transaction in the last few years, using these tools can be quite exciting and insightful. Next slide, Baljeet.
So some of you might find the idea of due diligence and excitement in the same sentence that's been using, but actually as a practitioner using this, it's amazing. And it's not unusual now for us with our clients with Dougal and his data analytics to believe and confess, if you like, that they understand their business far better after it than at any stage previously. In terms of what's next, brave man, as I said earlier, to predict, but here are some of the themes that we are hearing at the moment. So you won't be surprised to know that end markets which are driven by consumer spending have been put on amber by many potential acquirers. Thank you. What we're seeing is, for manufacturers, the nearshoring, reshoring, onshoring themes continue, much talked about, but is actually now being seen. Sector repricing. So there has been, in some instances, the opportunity for lower margin sectors to reprice to improve profitability, as well as to pass on cost increases. But those cost increases are real, and we're seeing the challenges, are we Dougal, of energy, raw materials, wage and forex coming in across pretty much every transaction now. The ESG agenda mentioned earlier is creeping up the agenda. The example for that perhaps would be the plastic sector. You may recall that Berry took over RPC, and that's been going through a divestment phase where it's been taking out non-core subsidiaries. But we are seeing both listed and non-listed entities look specifically for businesses which are either at the forefront of electrification or other ESG areas. Plastics, looking for the infamous closed loop and recycling businesses, and also diversifying, hedging the bets, if you like, into greater levels of paper, packaging and the like. Canning is going through an amazing increase too. We spoke about automation, digitalization, and anything that's connected with that, with process improvement, is a key source of creating value. So our predictions, it's already happened to some extent, a quieter capital markets for new IPOs. A number of those have already been pulled, and we expect that theme to continue during this year until there's greater visibility on the future. You would expect us to say there'll be a softening of M&A markets, although truthfully, we haven't seen that as yet. We have seen subsector, as I said, around consumer being looked at intensely, and perhaps that's now an amber. But actually for the remainder of the manufacturing piece, it comes down to value and timing rather than lack of interest. The strategic rationale for most acquirers remains intact, and the opportunity to find, particularly overseas, buyers interested in UK businesses remains as strong, surprisingly perhaps, as ever. So it wouldn't surprise us if there was a pause for breath, but at the same time, we actually think the fundamentals of the marketplace for M&A remain strong. So I think with that, we now are ready to take questions.
Brilliant. Thank you, everyone. Thank you, Seamus, Roger and Dougal. Some really interesting insights that you've shared with us today. We've had a few questions come through. So Seamus, if I start with yourself, with inflation soaring, with little effect of interest rate hikes on this, are we heading for a recession, depression?
It's a good question. I think based on the results that we're getting, the results that we've seen in recent quarters as well, and the general trend that seems to be likely over the next few months, it is likely that we are heading towards a recession, which is narrowly declined in economic terms as 2 consecutive quarters of negative growth, or a shrinking economy, in other words. A depression, however, I think is unlikely. A depression in economic terms there's no clear or universal definition, but it's generally seen as a loss of 10% growth for a sustained period, typically 2 years or so. While we are likely to be in difficult economic times for the next couple of years, based on the likely long-term effects of the lag effect of the COVID-19 lockdowns, and the fact that COVID hasn't entirely gone away just yet. And also, and more significantly, the war in Ukraine and the impact that that's having on the global economy, particularly as a result of the effects on energy prices and the knock-on and spillovers that causes. We are likely to be in significantly challenging economic times for the next 2 or 3 years, but I wouldn't necessarily go so far as to predict a depression. A recession is likely in the medium term, but we would hope that it would be relatively short and minor. A depression, I think, would be much more severe and is much less likely, thankfully.
Thank you, Seamus. And Roger, moving across to yourself, how long do you need to prepare when you're preparing for M&A?
Good question. I think if you're selling, I think a rule of thumb would be from the point at which you want to receive the proceeds, you should be allowed 12 months, ideally longer, but a 12-month period allows you to prepare. And there is a lot of preparation required to maximize value. There's a lot of things that you can adopt, actions you can take to enhance value if you do have a little time to prepare. And that's across balance sheet, profit and loss, presentation, products, etc. So we have clients who are preparing now for 3 years' time. Just to give you a sense of how long some businesses will plan out for. And we're helping them to get them to that place where they'll be ready to exit within that time frame.
Thank you, Roger. And one final question for you, Dougal. How often are you seeing data analytics being used on transactions in the current environment?
Look, I think the answer is we're seeing it more and more. We're seeing it on the sell side and the buy side. So on the sell side, it enables VD providers to get under the skin of the business and help present current trends in this dynamic market to bidders. And again, on the buy side, what we're finding is whether it's a corporate acquirer or PE acquirer, the individuals in the businesses are more data hungry. So they expect to see data supported answers. Whereas before you might be able to say, the management team doesn't currently track margins at that level, or doesn't track that level of activity with a customer or a site, etc. Now fundamentally the information is within their systems, so people want to see it and expect to see it as part of any sort of process. So whether that's done through DD or through the virtual data rooms, etc., then people are definitely more data hungry.